New today, the Federal Reserve raised the benchmark interest rate once again. It's now the highest rate that it's been in more than 20 years.
Ooh, Allison Gormly tells us what's the deal with why we keep seeing the increases happening.
The Fed keeps raising the interest rate because they want to try to cool off inflation. When you make borrowing money more expensive, people tend to ease off. So today they announced the benchmark rate will go up a quarter point after a quick pause in June. So what does it mean for us? If you have debt with a variable interest rate or an interest rate that can change, that can go up as early as the next billing cycle. For example, the average credit card rate right now is well above 20%, and rates for home equity lines of credit are at a 22-year high. Existing debt with a fixed rate like your mortgage or car note, that will stay the same. However, new fixed rate loans, those will be influenced by the changes. But million-dollar question, is the rate hike the last one? Well, we're not sure.
There's a lot of economic data and a couple of really important inflation releases between now and their next meeting in September. That's really going to dictate whether they raise rates at that point.
And because we like to end things always on a high note, let's talk opportunities.
Okay.
Savers, if you're a saver, look at where your money is parked. High yield savings accounts are now paying more than 4% on your money, and CDs or certificates of deposit are higher than 5%. But just keep in mind, you can't touch that money for a little bit.
Yeah,
Okay.
But it's interesting. There are higher rates for the shorter term and lower rates for the longer term.
Yeah, 9 month, I saw one at 5.35. And so it's like, okay, 9 months. I won't look at paperwork for that long.
Yeah. See, Allison knows what she's doing here. She said, let me let him down easy after that one. Thank you, Allison.